Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 29. An investor is holding 1000 shares of Atlas Company. Presently the rate of dividend being paid by the company is 2 rupees per share and the share is being sold at 25 rupees per share in the market. However, several factors are likely to be changed during the course of the year as indicated below. So the existing risk-free return is 12% and market risk premium, which is nothing but RM minus RF. Here we should not confuse it with the market return. They have given market risk premium, so it will be RM minus RF, which is 6%. Beta value is 1.4. Expected growth rate is 5%, and it's going to be reversed in these numbers. In view of the above factors, whether the investor should buy, hold, or sell the shares, and why. So we have to advise him whether to buy or hold or sell, and we have to give the reasons. Now, based on the existing and then the revised factors, we need to find out the existing rate of return of the respective holding. Now we can find it out by using CAPM model, whereas it will be risk-free return plus beta into risk on market minus the risk-free return, and here RF will be the risk-free return and RM minus RF will be the market risk premium, and beta is nothing but the sensitivity of the stock towards the market return. Now we have RM minus RF in both the cases, and we have risk-free return of also in the both cases and beta value also. So using that, the existing rate of return is 20.8% and the revised return is 15%. If they have given the actual return of the stocks with the existing and then revised, then we could have found out directly with the available data, directly with the CAPM return, whether we can buy, hold or sell. Since they have not given, we need to find out the price of the share, the existing and then the revised one, which we can find out by D0 multiplied by 1 plus G divided by KE minus G, and they have given the growth rate, and we have found out the KE, which is the expected return, and dividend also they have given, which is nothing but 2 per share. And okay, now the actual price of the share is given, which we can keep as the benchmark and then compare with the existing and revised prices. Now price of original share is given as 13.63 and the revised one will be 36.63. Now in case of the existing market price, which is 25 per share as they have given, when we compare it with the existing price of the share, existing theoretical price of the share, which is 13.63, the actual market price is higher, which signifies the share is overpriced by 11.37. But so since it is overpriced, in future the price might reduce, so the strategy should be to sell the shares as of now. But considering the revised changes, as we can see, the price, the theoretical price after the revised changes, it goes up to 36.33. Hence, comparing to the existing price, actual price, which is 25, the theoretical market price is higher, which signifies the price of the share will increase in the near future. So it is better to hold the shares now or buy if we can. Now the same ICAI also given the same thing. In case of existing market price 25 per share, the rate of return 20.4% and the equilibrium price of share at 13.63. This share needs to be sold because the share is overpriced. So same thing, needs to be sold currently as it is overpriced. However, under the changed scenarios where growth of the dividend has been revised at 9% and the return though decreased at 15%, but the possible price of the share is to be at 36.33. So the price will be at 36.33. Therefore, in order to expect price appreciation to 36.33, the investor should hold the shares if other things remain same. So the same thing they've considered, but they have taken one more thing, which is the existing return is 20.4, but the revised rate of return is just 15%. So actually it has reduced by 5.4%. But if we compare the growth of the share is increased from 9% to 5%. So 4% there is a share growth. So if we are just aiming on price appreciation in case of these shares, then we can just hold the shares till the price is getting appreciated. That's it. Thank you.